So we're first going to cover liquidity, and then we'll go into ranges. So let's go over the basics types of liquidity. We have the equal lows, known as double bottoms. We have the equal highs, known as double tops. We have trend line liquidity. And by this, it's the retail trend line, the ones that buy after every break structure, Fibonacci, all that stuff, right? EMA, etc. Then we have highs and lows liquidity. That pretty much is liquidity on every high and on every low, because there is liquidity on every high and every low and every structure point. And then we have SNR liquidity, which is support and resistance liquidity. That's when the market breaks a high or support becomes resistance. The breakout traders pretty much come back, tests, and it goes. This becomes liquidity. So these are the main ones, the main common ones: equal highs, equal lows, trend liquidity, structured liquidity, and then SNR liquidity, support and resistance liquidity, right? And then we have the ones that I'm gonna just call advanced liquidity, which would be external liquidity. So external liquidity, right? That is the end of the range. Or in other words, the high of the range and the low of the range is external liquidity, okay? Is the end of the range, the high or the low of the range. And then everything inside of the range is known as internal liquidity. Okay, internal liquidity, everything inside of the range. And then we have inducement. Inducement. All right. Now, what is inducement? Inducement, you probably heard it before, is a trap. Okay. It is convincing traders to do something. It is convincing traders to long. It is convincing traders to short. Let me give you an example. We have a break of this high, and then let's say we have a beautiful bullish engulfment candle. The retail traders love this. This is their confirmation, right? They will go long right here. So this right here is inducing them to go long. Long on every pullback, bullish engulfment, right? They're longing. Eventually price comes to a stopping point, which for us is our POI. And then what happens, it drops and takes them all out. So let's explain this in another way. It is building up liquidity, right? And it would pause before it comes to a point of interest, an area of interest. It won't hit it. It'll leave a little gap, all right? And then price, for example, here, you see how I broke structure? There are sellers coming in the market in here. There's sellers coming in the market. And then what happens is price pushes up, comes into our POI. And then that's where we short. That is what a inducement is, okay? It is inducing traders to do something that is wrong, which is a trap, right? Now, some people call it a smart money trap. I do not believe it is a smart money trap. That's just my opinion, right? They call it a smart money trap because the people that call it that. Either they don't know how to restructure, how to use structure, or don't understand what they're doing, but who knows, right? Who knows? But in my opinion, it's not a smart money trap because now I'm not saying that we're gonna know 100% or that I know 100%, but it wouldn't be a trap if you were able to understand structure and liquidity, if you were able to understand the logic behind it. I mean, if it's building up orders and there's a POI just above you, and we're thinking here logically, right? That's an inducement. There's, let's say, a POI here. It looks so obvious. Everyone shorts, and next thing you know, it takes them out and drops. But what are some signs that could give it away that it's an inducement? Well, one can be something like this, right? There's a POI right here, break of structure. But look, trend line liquidity. You are shorting on the third touch like the retail do. Fibonacci 61.8. You are shorting what the retail do. You are the liquidity. If you don't see it, then you become it. All right. So here's where we start to think, right? Just a little bit logically. Now, this has nothing to do with what I said in the previous video. Trade what you see and not what you think. By this type of thinking, I'm thinking logically. Don't think too hard. It's in front of your face, right? It's right there. Of course, I can't blame you if you don't see in the beginning, which you will with experience. All right, but I'm just talking in general. If this is liquidity and you see it and you got a feeling there's liquidity, it's a high chance that it is, right? So eventually you will get signs to let you know that's a trap or an inducement. And then it just goes, then it drops. So that's why I don't believe there's a smart money trap, because if you trade some quote unquote smart money, then you should be where the smart money enters, right? Because the smart money takes out the retail. So again, I'm not here to argue. I'm just here to state my opinions. So, but that's an inducement, guys. It's a trap. All right. So let's go back to where we were. That's the inducement right there. And that will fall into a point of interest somewhere in here. All right. And that gets taken. All right. Gets taken. And then anticipating price to come to the external. So after we take out external, right, we're coming back for internal. After we take out internal, we're going back for external. So far with me? All right. So now let's break that down. And we're still in the topic of liquidity. Just want to introduce this. All right. So before we explain that part right there, let's introduce the ranges real quick, and then we continue from that part because that's the only way it will make sense. So okay, a strong low is valid when it takes out liquidity, and then it breaks structure. Okay, a strong high is valid when it takes out liquidity and it breaks structure. All right, simple as that. How do you confirm a range? A range is confirmed when you have a bullish Quasimodo and then the opposite in the other end, like this. Then a range is confirmed from A to B. Okay, that is your strong low. That for now, we'll call it a strong high for now. All right, that's how you confirm a range. So now that we got that out the way, let's go back to where we're talking about external and internal. So this is external liquidity, the red line. All right, and then everything inside of the range is internal. The market is gonna come after the internal, and once the internal is done, it's done taken, the market has fulfilled its cycle. Okay, it's done. So the next target is going to be to take out external liquidity. So once internal is taken, we're going for the external. And once external is taken, we're coming back for the internal. All right. Now it's not going to look this perfect, but this is the cycle of the range. It takes out internal, then we target external. Takes out internal, target external. After external, we target internal. Okay. Now, why is that? Why does this work? So let's get into some more details. All right. So when we have our range from A to B, right? And let's say price came into a strong low. So this would be our external. And this is the internal. So why is this? Let's think about this in the retail perspective. How many traders, retail traders, have sell stops below these lows? These lows are protected lows for the retail traders. They're buying the dips. They're buying the dips. They have their stop loss just below, right? And then we have breakout traders right here. So when price comes down, right, they're expecting price to keep on dropping. They get tagged in and they keep on dropping. They got pending orders right there, right? Sell stops. The market's gonna grab them in the reverse because the market doesn't want you to make money. It doesn't want you to win. So after it takes out this liquidity, these traders, so when it takes out all the buy stops, what's left? All the sell stops that are resting above here. All these sell stops that are resting above here, which is, in other words, liquidity. All right. Because the market already did its part. It already took out all of these buyers. Now we're going after what? The sellers. Now we got to take them out. And when the market takes all of the buy stops, all those sellers, then what's next? Come back and take out the buyers. Coming back and take out the buyers. Now, the market's not going to move like this exactly. All right. The way it's going to actually be moving will be something like this. I'm gonna give you a more realistic scenario. And then we have, let's say, a low, low, a low. Okay. Let me just fix this. Oh, there we go. All right. We got a range from here to here. All right. So there is sell stops sitting below that. Breakout traders, they're expecting price to break and keep on dropping forever so they can make money. So what the market does is this, right? Just below this, there's gonna be a point of interest. Just below this is gonna be a PY. So what the market is gonna do is it's gonna take liquidity, tap into a PY, in other words, where smart money enters, and then reverse undo. And it's gonna keep on dropping. Let's go and tap these traders' orders and then reverse on them. This reverse, this pullback, right, is taking them out. It's taking out the people that got tagged in. And then it'll go one more time. And then what's happening? What is going on? When price making this reverse, there's sellers coming in the market. So now that builds liquidity. That's why we target the external range. We got trend liquidity, sometimes equal highs, all of that. And the market goes and takes out external. We took out sell stops. There's buy stops. All right here. Breakout traders all right here. And then what happens? It reverses. That's the range cycle, or that's at least what I call it. The cycle of the range, right? So now let's give you a realistic scenario of this. There's liquidity there. There's a POI just above this, just above this. The market is gonna take out the buy stops, reverse on them. Take out the buy stops, take out liquidity, reverse on them. And you want to take out this. And now what is this building? More liquidity. This is making sense so far. This is external and internal liquidity, which I just call advanced liquidity because it is kind of advanced, right? But you have to understand this and want to understand the ranges. And then of course we combine everything else. All the basic liquidity has strong highs and strong lows, but you have to understand this. This is the range, right? So that's external and internal liquidity. Now let's get straight into just the range itself. All right. So we know what a strong high is. Takes out liquidity and breaks structure. That is a strong high, SH. We know what a strong low is. Takes liquidity and breaks structure. That would be SL, right? Not stop loss, but strong low, right? That's the short term, right? Now, the strong high. Now we also have a weak high, which is WH, which also takes out liquidity and breaks structure. Then we have a weak low, which also takes out liquidity and breaks structure. But how do we combine this? Let me show you. So when we have strong low, when strong low is formed and a point of interest, they're pretty much always formed in the POI, right? when a strong low is formed in a point of interest, or just strong low in general, it will automatically, hear me out, it will automatically create a weak high. Okay? It will automatically create a weak high. So once that strong low is formed, we know automatically that a weak high is going to be created. All right? That would be a weak high. This is also automatically our target. All right? Our target, because we are in this range. It's automatically a weak high, and it's automatically our overall target of this range. Okay? So the same thing, once a strong high is created, it will automatically create a weak low. It will automatically create a weak low, which becomes the target for that range from A to B. Okay. So because it's weak, and that's our target, right? However, even though it's a weak high in this range, it is also a obstacle. It is also a obstacle. And for those that don't know what an obstacle is, it is something in the way of the overall direction or move. So what do I mean by that? I mean that this high inducement price can give you an entry, right? It can give you entry. Price will give you a reaction, let's say. Now, when price gives you a reaction, this doesn't mean this reaction right here is going to come all the way down and then go. No. We just know that it can give you a reaction. So write that down. All right. It can give you a reaction. Can you enter from here? Yes. Can you look for a short here? Yes. You can look for potential shorts here if it has liquidity, of course. Internal liquidity and inducement. Now, as we're talking about this real quick, internal liquidity is not the same as inducement. Internal liquidity, it's what's inside the range when it's forming. The inducement is a failure swing. Okay? Two different things. So in this scenario, we have internal liquidity. I'll change it. Internal liquidity and inducement feeding into this unmitigated strong high. In this scenario here, it's considered a strong high. Right? And the overall picture is a weak high. Right? But why is it a strong high? Well, now it's time to dig a little bit deeper into the ranges. When a range is created, and it breaks structure, a new range will be created. If this range is the 1 hour from here to here, then a 15-minute, let's say a break structure on the 15-minute, or this is the 15-minute break. Let's just call it that, right? A break structure. Then a new range will be created. So let's say on the 15-minute, we create a new range. After it broke this structure. So that's where you get a pullback and continuation. There's a range inside of a range. Okay? That's where this comes in play. All right? Another thing. Highs and lows can be shared. So what does that mean? So this red dot is the 1 hour, right? The 15-minute can also use the same high, but it will only be a 15-minute, let's say, strong low. These two can be shared. That high can be shared with multiple time frames. But you will not see this on the 1 hour. You will only see this in the 15-minute. This is going back to what I mentioned about fractal. Okay? Stay with me now. So this will make a retracement. Take out liquidity, and then you can short to fulfill the overall bigger range. There's a range inside of a range, right? So let's go back to this. So if this high right here was a broke structure, created a new range right here. That's a new range inside of this other range. So from A to B is inside of A and B. You see that? So because this is a new range, there's liquidity, this bigger range, right? The red one becomes a strong high because they're sharing the same range, or in this case, the same high. That's why we can get a reaction from here. And this can go and then give us that move to fulfill the bigger range. So far making sense? Now, you gotta be careful, right? Because if this already fulfilled the bigger range, it will still give you a reaction, but it will fail. It will fail to break this low right here. And because price fails, that becomes a what? Weak high, failure swing. That just feeds more liquidity. So you will get taken either break even or a loss. And that's why your move didn't go. That's why it didn't work. Okay. You have to understand this. All right. So that becomes weak, it will get taken. But if it's not, then it'll go. Regardless, your target is gonna be this low. Remember, we target external ranges, right? That's our target for every single range. Okay. So that's on that. Let's go to this one over here. Just colors. There we go. Right. So I hope this made sense so far. So now let's delete this. Let's go over some more examples of the ranges inside a range. So we have this range right here. Price broke structure. And let's say it's 1 hour. And let's color this purple. So the purple is the 1 hour. All right. So from A to B. And then we have 15-minute. So that would be green. Okay. 15-minute high is being shared, which becomes A, with B. Broke structure. Now it's going to create that weak low. Okay. In this range, because once a strong high is created, a weak low is automatically made. Our target is that weak low for that range, for 15-minute range, for range A. And then price will pull back up. And of course, we have some liquidity here. Take it out, right? And then we target this. Now, let's say we have liquidity right here on the bigger range, on the purple one. Right? That's where price is going to come into, and then go up to take out this external range. After internal is taken, external is our next target. So now, how can you maximize this short from up here? How can you maximize that short from up there? Well, if you know that the bigger range has liquidity, internal liquidity in here, and there's a POI just below, right there, then your target has to be the internal liquidity of this range. We're not going to target the POI. That's important. We're not going to target the POI. We're going to target the internal range of the bigger range. Whether it's the 4, 1, remember the market is fractal, right? If you're not going to target this low right here, then you can target the bigger range liquidity. Why is that? Because let's say that price does this. Let's say price takes this low out, and then this happens. It reverses. You just left all of this, right? Let's say that you were floating, let's say $1,000. Pull back, now you're floating only 100. Or maybe it took you at break even and then it dropped and then it went. See what I'm saying? So now we're talking in the perspective, let's say, right? If there was liquidity here and there was a POI just below that. So many colors, right? It taps into there and never hits the POI, and then it pulls back. And then it comes, then it goes. Okay? That's why we target the internal liquidity. Here, wrong color, but yeah, right there. But let's say price comes, reverses, just like the first time I did this, right? And it takes you out break even. Well, there's nothing you can do. That happens. Then it drops. And then it takes a liquidity, but it still comes back up. Then it drops one more time, then it goes. This can happen. It's simply building up liquidity. This is a more realistic scenario, of course, right? So that's where you pay yourself. That's why we target, this is our first target. The low or the high of every range external is our first, always our first target. In other words, I call it our safe target, okay? Because we have a higher chance of this just hitting to the T before it makes on top of reversal than if it coming all the way down here. because who knows, it could take forever before it comes down here. But it's our safe target. If you don't want to target this, you want to hold into here, then you're going to take partials. Now, how many? Well, not how many, but how much percentage or let's say partial should I take? That really depends on you, to be honest. I'd take 50% on that low. Because again, this could reverse and break me even and then drop. At least I paid myself, right? At least 50%. That's just me. Or you can take all of it, right? This is a personal choice because it depends on your account size. It depends on your goals. Are you compounding? Are you doing FTMO? Whatever. This is a personal thing. And this will be covered in a different video, but for now, let's say we take 100% right here. So nice. And the rest comes in here, pulls back, then it comes, then it goes. Okay. So I hope this makes sense so far. I know it's a lot of information to take in. That's why you gotta rewatch it. All right. So we covered liquidity. Okay. We covered external liquidity. External liquidity was covered. That's the highs. All right. And the lows. All right. That's external liquidity. External. We covered internal liquidity, which is what's inside the range. All right. While it's forming, that's the internal liquidity. And then we covered inducement, which would be a failure swing. Then it gets taken. That's an inducement. And then we covered ranges sharing a structure point, right? Sharing a structure point. That is happening here. Okay, sharing a structure point. So we got green and red is sharing this low right here. And sometimes they might even share the highs, but it goes vice versa. It goes both sides. Okay. And then we went over potential targets, which was the internal liquidity of a higher time frame range. If you're not going to target the external liquidity of your current range. We understand that there's a range inside of a range, right? And we also understood pretty much the difference between a inducement and internal liquidity, right? Now, let's go over one more thing. Let's say we create 15-minute, make an inducement, gets taken, comes to a point of interest. And we also have the same high being shared with this one. That's our first target. And then if the 1 hour is the white, the 15-minute is the red, then let's say the 1 minute is the purple. So the purple high was shared with the red. So the same thing happens, inducement, short, and we still target that range, right? This goes back to what I said. The market is fractal, a range inside of a range. Now, again, this is the basics of the range, okay? So I hope this makes sense so far. Like always, if any questions, you can ask me. There will also be some resources down below this video for those that want to read, or if you need any more help understanding this stuff. But that's it for this. On to the next one.